Good morning. As the MRAC designated federal officer, it is my pleasure to call this meeting to order. Before we begin this morning's panels, I would like to turn to Commissioner Sharon Bowen, the MRAC sponsor, for her welcome.
Hi, good morning, everyone. Thanks so much for coming today. I'm going to turn it over to Acting Chairman Giancarlo.
Thank you very much. I want to apologize in advance. I have to leave at 11:15 today for previously scheduled meetings on Capitol Hill. Therefore, I want to give just a brief opening statement and cover a couple of points since I won't be able to do it at the end. And when I leave, I've asked my Chief of Staff, Mike Gill, to take my seat. He'll give a few closing remarks on my behalf. So thank you, Commissioner Bowen, for convening today's meeting. Thank you for your sponsorship of the Market Risk Advisory Committee. I note for our audience that this is the 7th meeting of MRAC in the past 2.5 years. That is an enormous accomplishment. And so kudos to you, Commissioner, and your staff, especially Committee Moderator Petal, for really fine work. I found these meetings to be well organized, carefully prepared, and very candidly discussed. They're enormously valuable to the work of the Commission. And so I thank all the members of the committee for their very valuable time and expertise that they've brought to bear that have made this so valuable for all of us, and I think for everyone else as well. Today's meeting will address many aspects of the increased use of clearing for swaps transactions. As you may all know, the Commission is requesting additional resources that would strengthen our clearinghouse examinations capability. It will enable the staff to keep pace with the explosive growth in the number and value of swaps cleared by designated clearing organizations. There has been an enormous increase in the size and the scope of the major designated clearing organizations. So too has the complexity of the counterparty risk management oversight programs and liquidity risk management procedures of the DCOs here and abroad. This growth in volume and risk management procedures has been mirrored by an increase in the complexity of the products themselves. For example, the risks posed by credit default swaps differ from those posed by interest rate swaps. Accordingly, DCOs have developed a large number of individualized margin models and other risk management tools to address these different risks. This in turn generates a corresponding increase in the complexity of the Commission's oversight responsibilities. While not on the agenda today, I expect that we may hear this morning some discussion of the supplementary leverage ratio. I've advocated for some relief from the misguided application of the SLR towards swaps clearing, and I propose 2 practical steps. First, exclude customer cash collateral held at the CCP from the bank's leverage calculation. And second, take customer collateral held at the CCP into account in computing potential future exposure, and to do so in a manner consistent with the Basel Committee on Bank Supervision's standardized approach to counterparty credit risk. I believe these suggested leverage rule changes will significantly reduce capital costs for clearing members. By CFTC estimates, this potential reduction in capital costs could be as high as 70%, but it will translate into only a small 1% capital reduction at the bank holding company level. Assuming these savings are passed on to customers, these reductions would translate into a 3-fold increase in trading activity, especially hedge positions that are carried overnight. I believe such a significant reduction in costs on this service, which is imperative to managing systemic risk in swaps, is entirely worth the trade-off of a minuscule reduction in balance sheet protection. The financial system will be safer and more stable for it. It's apparent that many DCOs are expanding their services in other jurisdictions around the world. Those jurisdictions look to the CFTC to provide insight regarding the effectiveness of the programs implemented by the DCOs. The Commission supports the expanding international footprint of market participants through information sharing and compliance discussions with our counterparts overseas in the areas of cybersecurity, liquidity risk management, default management, and other high-profile risk management issues. And in closing, let me briefly comment on an issue that is the subject of today's first panel, and that is the location of euro-denominated derivatives clearing in light of the circumstances of Brexit. Last week, the European Commission proposed an amendment of EMIR to regulate third-party CCPs, including a process to introduce a CCP location policy. I look forward to following the path of this legislative amendment as it is considered by European institutions. I am respectful of the fact that this is an important regulatory policy development that needs to be made with great care by European officials. Nevertheless, I note that we are now upon the one-year anniversary of the agreement between the CFTC and the European Commission regarding CCP equivalence. That agreement was only reached through difficult and protracted negotiations. Throughout, the United States approached those negotiations with the utmost good faith and goodwill. Since then, we have demonstrated our unwavering commitment to that agreement. We view that agreement as an important signal to the markets and to the international regulatory community of the ability of the United States and the European Commission to work together successfully on critical cross-border issues. Therefore, whatever the outcome of the Brexit negotiations and the EU's internal discussions about how to supervise CCPs, we do not contemplate any change to the CFTC EC equivalence agreement in its current form. I'd like to once again thank our speakers for sharing their time and expertise, and to everyone here for attending, and once again thank Commissioner Bowen and Petal Walker for their fine operation of this committee. Thank you very much.
Thank you so much.
Thank you for your opening remarks. As noted in today's agenda, our first panel discussion will be on the risk surveillance activities of CFTC's Division of Clearing and Risk. I'd like to introduce Mr. Luke Zubrod, Director of Strategic Initiatives at Chapman Financial, who will facilitate and help shape the discussion during this first panel.
Thank you, Petal. And let's start out by introducing our panelists today from the Division of Clearing and Risk. With us we have Hugh Rooney, Joseph Miller, Glenn Schmeltz, and Eileen Donovan. And we're very pleased to welcome them. And starting out with a presentation today, and then we'll leave time for Q&A amongst committee members, so be thinking of your questions. Just as a reminder on logistical announcements here that these are touch microphones, so please keep the microphone a few inches away. When you wish to speak, press the white button, and when your indicator light appears red, your microphone is on. When you finish talking, please press the microphone again to turn it off. There are only a limited number of microphones that can be active at one time, so please turn off your microphone after speaking to allow others to jump in. And then again, please refrain from putting any mobile cell devices on the table, as they may cause audio interference. So with that, I'll go ahead and turn it over to the team here.
Thanks, Luke. I'm going to begin with a quick overview of the Risk Surveillance Branch, which we'll be referring to as RSB throughout this presentation. Then Joe will describe RSB's core risk monitoring program. I'll then talk about some other programs and projects RSB is working on. And finally, Hugh will explain our 173 review program. Ensuring the financial integrity of transactions and the avoidance of systemic risk are objectives included in the Commodity Exchange Act. RSB was established a dozen years ago within what is now the Division of Clearing and Risk to help the Commission fulfill those objectives. We strive to conduct independent assessments of the risks posed by market participants, primarily through stress testing. In the June issue of FIA's Market Voice magazine, my RSB colleagues referred to these independent assessments of the risks as the fourth level of financial regulation. RSB currently has 28 employees, 20 in Chicago and 8 in DC, with experience as auditors, investigators, and traders at exchanges, the NFA, clearing members, and hedge funds. Here's a laundry list of the areas of responsibility for these 28 people, divided into 3 teams. Team 1 has responsibility for futures and options and uncleared commodity swaps risk surveillance, cleared and uncleared credit default swaps and uncleared equity swaps risk, data systems, and overseeing the 173 review program. Team 2 monitors cleared and uncleared interest rate swaps, cleared and uncleared foreign exchange swaps, clearing member risk profiles, swap large trader analysis, margin backtesting, and internal reporting, which includes daily initial margin and variation margin analysis and longer-term industry analysis. Team 3 includes our quants and is in charge of margin model reviews and analysis. And finally, our systemic stress testing program and our SIM program development both draw on people from multiple teams. As you know, more positions are being brought to clearing. Over the last 3.5 years, initial margin requirements at these 8 clearing services have risen from less than $200 billion to around $320 billion, which is a 60% increase. Futures have increased 28%, cleared CDS 37%, and cleared IRS has increased 160%. IRS actually accounts for 2/3 of the growth in cleared initial margin requirements over this period. The reason RSB is able to operate at the 4th level of financial regulation is the data that we receive, and the amount of that data received daily is increasing. At the end of 2012, we received just over 1 million records daily, including large trader data from reporting firms. In 2013, about 15 million records were added with Part 39 data from derivatives clearing organizations, or DCOs, which includes position and cash flow data. By the 4th quarter of this year, the total is expected to be 60 million records daily with the addition of client-level reporting in Part 39. CFTC receives these data from 19 DCOs across multiple market segments, and this is what makes us unique. We see trader positions across clearing members and across DCOs. Next. This network graph shows initial margin requirements at all member firms at the parent level, clearing at 5 DCOs. You can see why the view across DCOs is so important. The large clearing members in the center clear at multiple DCOs. For this graph, we've turned off the labels, but of course when we use this tool internally, the firms and DCOs are labeled. We can filter to see only house or only customer accounts, and if we select any node on the graph, all the connections are highlighted, making it easy to see the number of connections and the relative magnitude of each. The data are always as of the close of business on the prior day. After we start receiving client-level reporting in Part 39, we can begin the work to enable us to use this tool to see connections for individual traders. To set the stage for Joe, at the core of our risk surveillance, RSB identifies significant positions, estimates the magnitude of the risks of those positions using stress tests, and compares the potential losses to available assets such as initial margin and excess net capital of the clearing firm. If this analysis uncovers accounts with the potential for concern, RSB investigates whether other assets are available, such as equity in the account or lines of credit. RSB regularly contacts traders, clearing members, and DCOs, and will implement monitoring and escalation procedures if necessary. Now, Joe, continue.
As Glenn indicated, with the various backgrounds and experience of the risk surveillance staff, this results in a number of different techniques and processes and reports. The risk surveillance branch process is to be proactive in its approach. We look to identify traders and clearing members in the markets before they become volatile. A number of characteristics may trigger more scrutiny: absolute size, short option size, size relative to the market, initial margin on deposit. But to do this, we have a number of different reports. The position risk summary report generated per trader with the capability to aggregate like risk across DCOs. Some examples of that would be crude oil, natural gas, equities. These are used to find risk. We, for example, would look for large positions at a small firm. We also look to futures equivalent delta position reports to identify the largest positions in each contract and commodity group. These reports are very customizable. We can view the net delta by product. We can remargin, we can stress, we can sort for the greatest risk, bringing, for instance, short options to the top. We have reports to identify notable short option positions. We use various option analytics, metrics, and look for accounts that may need further scrutiny. An example of an option report would be our Vega report, which looks for net option accounts and which we would stress looking for hidden fat tail risk. Another report would be the inter and intra-commodity spread position reports. We would analyze them for correlation breakdowns. We look at both these type of reports, both short option traders and spread traders, because those type of trading traders usually have that 1% fat tail event that we look to uncover. And of course, that would result in enhanced scrutiny if we should find something that we thought was something particular we would look at. One of our important jobs here in the risk surveillance branch is stress testing. We use a combination of proprietary and vendor risk management software systems. Our tools help with this analysis, and many of our reports are configurable. We can sort for various ratios and metrics. We can highlight the riskiest traders and concentration of those traders at clearing members. Daily, we have an automatic stress test that produces more than 5 million records. This is done using 23 stress tests on over 7,000 portfolios with over 1,000 products. But we do have the ability to go up to 100 stress tests. Software has an ad hoc stress testing capabilities, allowing the analyst to create customized worst case scenarios for each account. We look to the product level, price moves, volatility moves, and we look at all cleared swap data at the beneficial owner level. Risk Surveillance Branch aggregates stress test for loss across DCOs and clearing members, giving Risk Surveillance Branch the highest level of surveillance in the industry. Next slide is a chart with hypothetical data. So the program focuses on high-risk accounts identified by RSB. We look across various statistics. The Risk Surveillance Branch produces a number of internal reports to track traders and markets and the impact of various stress tests have on them. Below is an example of a report showing some of the stress tests and the potential losses on those accounts. An example is the trader and the scenario that generates the greatest loss for that trader is shown in the report. And it's ranked by the greatest unsecured loss to X net capital. If you look in the chart, variation could be seen also as stress test loss. Margin is what they have on account, and the unsecured risk would be loss that's greater than margin. And what we can see there is in this report, Trader 2 with an unsecured ENC of 55% has a margin to ENC over 250%. This account appears to have a large concentration at its clearing firm, whereas Trader 8 has an unsecured to ENC of 20%. It has margin to ENC of 5%, so it's not very concentrated. A report like this gives us valuable insight for less well-capitalized firms with risky traders. It also should be noted that ENC can vary anywhere from as low as $1 million to upwards of $14 million, so it's also relative. And the next slide is all hypothetical data, and it's one of our tools. Our next slide is hypothetical data, and it's one of the tools that we use. As mentioned earlier, stress testing is one of our most important jobs. We use a combination of this proprietary and vendor risk system software. The results is a snapshot that we have right here. It's a quick look and a visual way to see risk. It is based on choosing a stress test loss from a suite of stress tests. The interactive tool then displays the affected traders. The heat map of the traders is sized by margin relative to others. So if we look at the boxes inside a heat map, largest box equals the largest margin, and then the color of the box indicates the profit, which would be in green, and losses in red. And then we can also click inside the heat map and see the positions of that trader, which would be displayed in the upper right. And we can see there that WTI crude and heating oil are having larger losses, while the crack spread and the Brent is profitable. And then below that, we get a little bit further detail where we can look at the positions along the curve, and we can see that this is displayed by the net delta, the higher stack bar, the more positions they have, and the profit would be indicated in green, and anything other than that is either a smaller profit or a loss. And also, there's another aspect of this report that we can actually rank the greatest risk at the top of the report. And if you refer to the next slide. So all this could result in possible actions of RSB if we have concerns about a trader's risk. We generally have three choices. We can contact the trader, its clearing firm, or even up to and including speaking with the DCO. We would discuss additional assets the account could appear adequate for unique. We could discuss additional assets that the account may need for their unique risk. RSB may require weekly reporting on the clearing member. The Risk Surveillance Branch continues to express concerns regarding the account that clearing members have required the trader to deposit additional margin, as mentioned before. We've also found that they've asked the trader to liquidate or move some positions to a different clearing firm, and or ask for additional capital or lines of credit. Often and typically, we would contact the trader first and find out their trading strategy and present our results of our stress test. And in this conversation, we could find out perhaps what type of trader they were. They could simply be, one set of risk and be a hedger, and it's perfectly fine. If it was something other than that, we'd maybe find out about additional financial resources, lines of credit, parent guarantee, something like that. And of course, we would work with other CFTC divisions as appropriate. Another report that we like to send out is called our quick report or firm profile. This report is a structured and fairly quick pull of firm data. It is used to convey information on a firm to senior staff when prompted by market events or corporate events. And it would usually contain the types of information as the firm's number of accounts, the list of clearing relationships, looking at the interconnectedness of the accounts. We would look at variation margin to initial margin percentages, and over 30 days, how many of the firm's accounts breached margin. We would look to see for the account whether it has excess collateral at a clearing member or a DCO, and we would look at the firm's largest customers and aggregate that requirement, and we would look at the total requirement versus other firms. And then we'd also want to know the large swap accounts and the type of swap trading they were doing, IRS, CDS, FX. And then finally, we would add additional firm financial information that we may find out in interviews, conversations, or public information. Thank you.
Initial margin is the first line of defense in a default, so margin adequacy is a crucial component of risk management. The Act requires DCOs to conduct back testing to test the adequacy of initial margin for futures products and spreads and swap portfolios. Major DCOs report backtesting results to RSB on a monthly basis, which RSB reviews to look for shortcomings. RSB also performs independent backtesting analysis for benchmark products. When necessary, RSB will verify that DCOs are margining products according to their own policies and increasing margins as volatility levels dictate. To enhance our surveillance of risk across DCOs, RSB conducted a supervisory stress test of clearinghouses, or SST, and published a report in November of last year. The analysis confirmed that each DCO had pre-funded resources to cover any two simultaneous clearing member defaults. We found clearing member risk to be diversified among the stress scenarios included and across DCOs. In other words, there was no scenario that hurt the same pair of clearing members at every DCO. RSB is transitioning this work into a systemic stress testing program and is currently focusing on automating it so that it can be run at any time with little or no manual effort. We'll switch from large trader data to Part 39 so that we include all futures customer positions and all positions at ICE Europe. The futures component should be automated this year. Swaps will be added into the same system as futures next year. On a separate track, RSB is currently working to incorporate liquidity into an SST. In other words, in addition to assessing whether the default fund is sized appropriately to cover potential losses, we'll assess whether collateral is liquid enough to be available when necessary for variation payments, even if one or both of the defaulting members were a liquidity provider for multiple DCOs. RSB staff was involved with 14 other authorities around the globe in the Joint Study Group on Central Clearing Interdependencies analysis. Data were collected from 26 of the largest CCPs as of September 30th of last year, including data on clearing members, settlement banks, custodians, investment counterparties, credit, and liquidity providers. All the data were anonymized. The analysis of this first data collection is complete, and a report is expected to be published by July 5th. The analysis generally confirms that some interconnections in central clearing are large and concentrated. A second data collection is being planned for later this year. RSB staff was also involved in creating the CPM-IOSCO framework for supervisory stress testing of CCPs, a consultative report, which is expected to be released very soon. The framework was developed to provide guidance to authorities on the design and execution of a multiple CCP SST. It is non-prescriptive, flexible, and voluntary. It should be particularly useful for authorities designing their first SSTs or for designing a multi-authority SST. These SSTs could help authorities better understand interdependencies between CCPs and service providers. RSB is beginning work on a couple of fronts to help client porting go smoothly in a default. It is currently finalizing a survey which will be sent to clearing members. It will ask clearing members about their interest in accepting different types of customers, the number and size of customer they could accept, the types of information they would need in order to make a decision, their thoughts on customer file formats, potential regulatory impediments, etc. RSB believes that when porting customers after default, it will be important to have certain information about the customers ready in advance. RSB is beginning work to develop an internal database to link customers across clearing firms, asset classes, and DCOs. And will explore other means to accomplish the same objective of helping porting go smoothly in a default. RSB staff has been working with the Bank of England, BaFin, and Bundesbank staff, along with staff from CME, Eurex, and LCH on a multi-CCP default exercise. Each DCO began drills on April 24th of this year, but completed drills according to their own schedules. Regulators are nearly finished with post-drill interviews. Preliminarily, the results support our confidence that if a large clearing member were defaulted by multiple CCPs, non-defaulted clearing members have the resources and capacity to provide traders to CCPs' default management groups, bid on hedges, and successfully bid on portfolios. One area where there seems to be potential for further improvement is auction file formats. Greater standardization of the auction file formats of different CCPs could improve the efficiency of clearing members ingesting and analyzing the defaulted portfolios. Very soon, CME, Eurex, ICE, and LCH will begin a discussion with regulators and clearing members exploring the potential for further auction file format harmonization. Regulators have plans to focus on client porting in the next year's joint drill. Next. The following are points I'd most like for you to remember about the risk surveillance branch. We have a lot of data to work with. We are enhancing our ability to analyze these data using technology. We conduct our own stress tests and always strive to operate at what we refer to as the fourth level of financial regulation. Our niche is that we see more of the whole picture in derivatives markets than anyone else. We see traders across clearing members and across DCOs, and we have access to most uncleared swaps positions.
173 program. Regulation 173 is the CFTC's regulation for risk management that affects clearing members who are also registered as future commission merchants. The regulation requires that certain risk management procedures be done within certain time frames. And our program goes out and evaluates their compliance with these. The first thing is, and the current slide up there shows the general requirements of the regulation without getting into the legalese and all the different clauses. Each clearing member has to establish risk limits, risk-based risk limits for every customer and every house account. Simply, it could be something like, this account cannot exceed 1,000 S&Ps long or short. That's a typical risk limit. In addition, every order has to be screened electronically or automated fashion that shows compliance with the risk limits. It's also part of that order screen is also to prevent rogue traders, to ensure that there's a risk limit there, and so someone can't go in, plug in a ridiculous number and have it go through. Then each clearing member has to do stress testing of every house and customer account on a weekly basis. Those tests have to comply with our extreme but plausible requirement, and most people know here that came out of the international regulators. We adopted it. It can be somewhat dicey understanding what the extreme but plausible is, but we've had great success in dealing with the clearing members. We haven't really had a dispute there on what extreme but plausible means. Then after they conduct the stress test, they have to see that they have the ability to fund the variation payments, that they can manage those stresses. They have to do that again for the house and the customer. And for the customer side, they have to demonstrate they have the ability to fund those variation payments if the customers can't. So they have to show that they can cover all their losses, but they also have to show that in the event that customers lose more than they have, they can come up with the money. The next requirement, the ability to, and again, those are done on a weekly basis, the evaluation of the ability to liquidate open positions. That has to be done on a quarterly basis. And that requirement, over the years, the RSB noticed that we've run into a few traders over the years who've caused significant financial harm to their clearing members by having positions that became very large losses that they couldn't liquidate. And the reason they couldn't liquidate them, it was often a complex option position with a lot of positions on in deferred or illiquid months. Someone might be short puts in the 2026 crude oil option and at a particular strike. And as the position starts to fall apart on them, they can't get out because no one's out there who wants to take the other side. In a visit last year, to one of the clearing members, they discovered a customer like that. We've had at least one instance in the last year where they discovered a customer where they said, yeah, if this market moves against him dramatically, he won't be able to get out and we're going to get buried. So they had that customer break up his position and move it to different clearing members. That was, we thought, a large success within our program. And the last requirement is to test lines of credit. And that's done on an annual basis. And they're the only lines of credit that would, if they're using a line of credit to fulfill the funding of variation payments. If they have other lines of credit, whether to pay their rent or their employees, we don't worry about those. This is general. The way we generally conduct these, we call a clearing member, we tell them we'd like to come and visit you within 4 to 6 weeks. Then we send them an engagement letter and a record request specifying what we want. One of the things we typically want is that we select 2 weeks in the recent past, usually in the last quarter. We want your weekly stress tests and your weekly analysis of how you're going to fund those stress tests. And then we begin the analysis in the office. We go through the records, making our evaluations, and often phone calls back and forth between the clearing members, asking them questions and trying to get it straight. Then it comes down to we have to go into the field, and there's certain things we can't do in the office. We go to the field. We're generally in the, and so one of the other records we look at, I'm just trying to get back, this is rejection logs. As we said, one of the requirements is that we have to have an automated system to ensure that trades don't go through within the risk limits. One of the common techniques to evaluate whether that's working is we get their rejection logs, and we can see all the trades that their systems have rejected. That's it. On-site review, we're generally in the field, although we go into the field, we're generally over there 1 to 2 days, and that seems to work well. The firms are happy that we're only there 1 to 2 days, and we're in and out very quickly. We bring typically 2 to 3 staff members per review. Joe mentioned earlier, or Glenn, the diversity of our group, the different backgrounds we have. Generally, we staff that with one supervisor, someone who has a trading background, and someone who has an auditing background. By bringing together a trader, we're all risk analysts, but by bringing together someone with an auditing background and trading background, we get particularly good insight in how the program works. The auditor is there to help us ensure that our work papers are done properly and we're doing the proper amount of scoping and evaluation. And the trader has a unique insight into some of the risk principles that we're involved in. We meet with the key personnel at the clearing firm, and we compare the clearing member stress test to CFTC values. As most of the presentation talked about, we conduct daily stress tests. We get our stress tests for that firm for that week and compare them to what the firm is doing. Generally, there are not material differences. The stress tests we run are consistent with the stress tests the clearing members run. If there are material differences, we sit down and try to hammer out why there are differences. It could be an error by either side. It could be that certain contracts were included or excluded, and sometimes it's the aggressiveness of the stress test. And we work through with the firm trying to figure those things out. And it serves as a good check against our own internal issues here. Are we doing what people in the industry are doing? And as an aside, obviously, the clearing members are the ones who are often very aggressive in their stress testing because they're the ones who are going to lose the money. They're the ones going to have to fund the variation. If we mess up a stress test here, no one asks us for the money for variation. So the firms are obviously very good at it. As we go through, it's also a good time for we've been observing each firm has particular traders we are concerned about, and that's the time where we will always discuss those traders. If we don't have an alarming situation, we wait until we schedule a review. When we go in the review, and we notify them up front, we'd like to talk to you about these 3 traders. We're concerned about their risk, and the firm is then prepared to talk to us about it. At the end, we have an exit interview, sort of typical audit procedure. We discuss with them what we've observed, what we've learned, and we make recommendations if appropriate. And our report, we note any issues of non-compliance. And we say it's a review. I actually tend to use that in the technical sense of an auditor, in that a review is much narrower in scope and audit. In an audit, we have much less testing and sampling involved. And when we note issues of non-compliance, we issue generally one of 2 types of letters. We either say we did not detect any issues of non-compliance, or we detected the following issues. We typically give a letter saying if we've had non-compliance, what do you expect to do? Please let us know in the next 30 to 60 days how you expect to rectify these. So far, we've been very successful with that. We've been to every firm subject to this regulation the past 3 years. There's about 50 firms that are subject to this regulation. We've issued 15 to 20 compliance letters, and they've all been resolved amicably between the division and the industry. The typical findings early on in the program, the requirement that they demonstrate that they can fund customer losses. There was a confusion in the industry on what we meant by that. And they would typically show us why they wouldn't have to do it, because the customers are highly capitalized and had a lot of funding. And we told them it was implicit in our regulation that that's not what we're looking for. We're looking for when those customers can't. And we worked that out. And the other problem we've had in the generally smaller firms is lapse coverage overnight. The regulation requires that you have a 24-hour program. Some of the smaller firms had some challenges there in not monitoring overnight positions. Again, we worked through that and it's solved. Our liquidation analysis requirement, I won't go into details here. There was a lot of confusion on what we meant by that. They thought a lot of people in the industry thought that we wanted them to demonstrate that they could liquidate every customer they had on a given day. Our intent was to identify customers that would be problematic if they had to liquidate. So again, we worked through that. And occasionally firms are meeting the spirit of the regulation, but they're not documenting their procedures or maintaining their records. And that's sort of a simple fix. Some of the benefits of the program, again, like all of what we do in RSB, we have a view of designated clearing organizations over everyone. If someone is just long equity positions at the CME and short at the ICE, we get to see that. We get to see those net down to not a big problem. Vice versa, if they're long at both DCOs, we get to see that and observe and calculate a better risk profile. It's also been successful that we've developed these relationships with the clearing members. We know who to call in the event of a problem, and we have a relationship where they'll actually pick up the phone and talk to us most of the time. And the field work enhances our industry knowledge, and that's very important to me. I've been with the commission a long time, and one of the criticisms you often hear of regulators is they don't understand the industry, they don't understand what's going on. And I think the best way to mitigate that is by having us in the field. Certainly no one wants us out there every day, but when we go visit the clearing members, I've learned something on almost every review. And I've been in the derivatives industry a long time. Things are constantly changing. And in the past 5 years with Dodd-Frank, things are constantly changing. Firms are coming up with new procedures. They're bringing in new risk tools. And by going out there, we can stay on top of that and understand it. And those times when they need to call us, I think we're in a better position to discuss it with them because we understand what they're talking about. And also affords the on-site analysis of risk and procedures used. Again, we've been to all 50 firms that fall under this regulation. So we've observed firsthand all of the risk systems, and we know their fundamental approaches to risk. Clearing members approach risk in different ways. Not everybody approaches it the same way. Everybody has a little different take on how they look at it, and we've got that knowledge now on how every firm looks at it. And the last point here is clearing members have voiced support for our review program, and that grows out of the mutualization of risk, since in the event of default, everyone's on the line. Now, when we call a clearing member, I don't think they say, yay, these guys are coming here again. But what they like is the fact that we're going to other firms, and they know we're creating a level playing field for all the clearing members. I think they take comfort in the fact that there's firms they're concerned about or they hear issues, and we go in there and take a look at them. And I guess we turn it over to Luke here now. This is the end of our formal presentation.
So
Yes.
before, I just want to thank you so much. I can tell you when I first learned of all the work you were doing, it gave me great comfort that we were at least addressing one of our core missions of oversight. So I just want to thank you for presenting this. I think this is the first time, publicly we've shown the audience the depth of the work that we do.
So let's open the floor here to any questions. If you have them, go ahead and, as per our custom, just signal your question with your name card. Richard.
Yes, just to echo Commissioner Bowen's compliments, I'd like to also compliment the staff on providing transparency into your market surveillance activities with respect to CCPs. I know I've been in the industry a long time, and I would note that this is probably the first time we've seen this level of detail and description of your activities, and it's important because it provides comfort to market participants, particularly market participants like my clientele, who are insurance companies that have no choice but to use the clearing system, and are need to feel it is safe and secure. But I do, beyond that comment, I do have a couple of questions. What steps do you take, or do you take steps to share information or gain information from other regulators? Particularly, I'm thinking of bank regulators with respect to the large clearing members who are banks, and the SEC with respect to active hedge funds and the like. Do you have information sharing arrangements and protocols with your colleagues at these other agencies?
I don't believe that we have extensive formalized procedures with them. As events take place, obviously we work with them. There was a broker-dealer a year ago who was having financial problems, and we worked with the SEC, and our group worked with them, coordinated, what problems we have and how that could bleed into into the clearing side. We stand ready to work with everybody. Now, on the other side is there's another part of RSB, the examinations group that looks directly at clearing organizations that works extensively with the Federal Reserve and other regulators. We get more of that cooperation comes through the examinations group than through the risk surveillance branch. It's all under the umbrella of the Division of Clearing and Risk, but the examinations groups works more closely with the other regulators. We have more of an ad hoc relationship with them.
Thank you, Hugh. And in the interest of time, as we're nearing the end of it, Marcus.
Thank you, and thanks for the presentation and for the work you do. I'd just like to get, this might be kind of an elementary question, but a better understanding of your oversight of the clearinghouse margin models. As I understand it, you set the scenarios using your own sort of internal analysis of the market, but then are you dependent on the clearinghouse internal models in order to translate those scenarios, stress test scenarios, into losses? And do you, how do you check, for example, the correlation assumptions across risk classes in those models?
Our team 3, as I call it, or quants, or the margin model group, reviews any new margin models or changes to any margin models, and must approve them before they go into effect. And there is ongoing monitoring of those margin models. I guess I see stress testing as somewhat different, and that's what we do, which, you know, we compare stress test loss with the margin calculated from the margin models.
Just comment is, Glenn earlier said within the risk surveillance group there's 3 teams. 2 of those are represented here today. The margin model team folks are not on this panel, so they would provide you with much better questions. They're just not on the panel today, and unfortunately.
Okay, maybe I can follow up with you
Sure.
on that to talk to them.
And last question we'll take from Dale Michaels.
First of all, good presentation. I commend you on the work. Question for, I think, Hugh and likely Joe and or Glenn. On the liquidation exercise that you guys look for the clearing members to perform, what is it that you're looking at particularly, especially with some of the exchange traded models that don't take in the types of liquidity risk that might be that might exist in the market? What are you looking for the clearing firms to do in particular? I think that would be interesting. And on the back testing on a 99% level that all the CCPs must adhere to, how do you look at the 99%? A few different ways to look at it. You know, from LSEC accounts, do you look at every single LSEC account? Do you look at it in aggregate basis? I'd be interested in thoughts on that one as well. Thanks.
With respect to the liquidation model, as we do the 173 review, we make the request and ask them to demonstrate how they comply with the regulation. And then we see what they have. And there's a variety of ways to do it. It's typical that they will add some sort of loss with respect to liquidation. So you take this portfolio, it has a net liquidating value of negative 50 million. Then they build in some sort of model to say, because of the liquidity problems, we expect this to lose 70 million when we liquidate it. We have no recommendations, and we don't have an internal model for it. We accept what the clearing members provide. And to this date, we haven't found any clearing member we thought was deficient in that area. They all do it, some more sophisticated than others. Obviously, the firms that carry a lot of option traders and have a lot of those positions are more sophisticated at it. The firm that I mentioned in my presentation that rejected a customer was one of the most sophisticated firms in the industry. And at the lower end, I mean, not the lower end, the smaller end of the industry, or the less capitalized firms, they reject a lot of that business out of hand anyway, so they have less of that anyways. With the firms with less excess net capital, they limit the amount of customers that can do these sort of the more complex options. If that answers your question.
In terms of the back testing, I'm not 100% sure exactly where that stands today because I've been out of it for a little while, but I guess the way I would think of the 99% would be that the margin should have the portfolio should have margin breaches fewer than 1% of the days in the long run on average. Um, I I do not think that they look at every single LSOC customer portfolio. Certainly, our our oversight is focused on the core, the larger portfolios and the core products.
Well, I think with that, we've reached the end of our time, and I'd just like to thank you. I think, I'll echo a word that both Richard and Commissioner Bowen used, comfort. I think it's clear that, through reform, we've moved a lot of risk in the market into clearinghouses, and I think many, speaking for smaller market participants, folks who are subject to the clearing requirements have limited capacity to evaluate the risks within these markets. And so I think there's comfort in being able to understand them to a more granular degree, which you've afforded us this morning. It's helpful to know that you're evaluating them, that you're mitigating against them, that you're doing so at multiple levels, from customer to clearing member to clearinghouse, and on a global scale. So really appreciate your comments this morning.
Thank you, Luke. At this time, we'll take a very short break, about 3 minutes, and reconvene at 10:55 for our next panel. We will start in about 2 minutes. Please have a seat. We're going to be starting shortly. Thank you, and we'll start again. As noted in today's agenda, our second panel discussion will be on an economic perspective on the clearing regulatory framework. I would like to introduce Robert Steigerwald, Senior Policy Advisor, Financial Markets at the Federal Reserve Bank of Chicago, and Sai Srinivasan, our Chief Economist, as well as Richard Haynes, also part of the Chief Economist's Office, who will lead the discussion during the second panel.
Thank you, Petal, and I hope to set a good example by speaking into the mic very clearly and loudly so that all can hear. I'll spare you the rest of the instructions and just rely on my example. So a lawyer, a mathematician, and an economist walk into a bar. No, that's for a different occasion, but it actually describes the diversity of experience represented on the panel here today. Sai Srinivasan, of course, as Petal noted, is the chief economist for the CFTC, and Richard Haynes is supervisory research analyst in the office of the chief economist. I am at the Federal Reserve Bank of Chicago, which obliges me to make a disclaimer, which I will make broadly on behalf of all of us. The views and opinions expressed today are solely our own and not those of our respective employers or any other official body that may come to hear of what we have to say today. Our remarks today concern a program for thinking critically about policy issues. Sai will share with you the inspiration for his thinking. I want to especially reference my mentor in economic thinking, formerly at the Federal Reserve Bank of Chicago, Dr. Edward Green, who wrote a seminal article some time ago titled, "We Need to Think Straight About Electronic Payments." Our topic today is not electronic payments, it's central clearing, but thinking straight, thinking clearly, and understanding the importance of policy trade-offs is a necessary condition to good policy making. We're going to open with remarks by Saeed, and then Richard and I will interact over some particular issues that we hope will illustrate some of the broader concepts that Saeed will share with us. Saeed?
Thank you, Robert. Thanks, Petal, for letting us loose out here. And thanks to Commissioner Bowen for chairing this. This is, I think, what you're going to be hearing from us is what do the economists and others, how we go about thinking about CCP issues. One of the challenges we have, or at least from our perspective, is that there really isn't a conceptual framework yet in the research community to systematically study CCP issues. It's still work in progress. Sort of market structure issues, people have been working on it for a long, long time. But if you ask me how many academicians are actually actively doing research, good quality research on CCP issues, I have a hard time using both my hands. That's the state of the world, but it's still work in progress. So the way we were debating on how to sort of motivate this discussion, and in a standard academic conference, they'll put out a model, and very soon most of us will fall asleep. So I thought, why don't we sort of boil it down to some very basic principles, I guess. So when we start thinking about these issues in a systematic manner as economists, we try to write a model. And what the model does is it's trying to, in a very simplistic manner, describe the world we live in. And we're all sort of familiar with the standard demand and supply curves. It's sort of a two-dimensional representation of the world. And we also know that the real world doesn't work that way. And sorry. And a few years ago, this was sort of illustrated very well to the Laffer curve, which basically said that Laffer was an economist from the University of Chicago, said that if you sort of draw the curve differently, it's clear that you can have the same tax revenue coming from two different tax rates, and your choice on where you want to be depends on what are the trade-offs that are involved in making the choices. And the other point, which is increasingly sort of relevant as we think about CCP issues, especially given that we have a regulatory structure in place, is where you want to go depends on where you are. And many times it's not clear to us that we have a good understanding and even consensus on where are we today. So that's the point which I think Richard and Robert will also get into as we sort of go forward. So I try to extend it through an issue which comes up regularly, and we heard it discussed even in this committee here, and also the academic community is getting involved in it, is skin in the game, CCP, skin in the game. And we see some representations where the argument is made that more capital is better. Right. And the question that I ask when I see some of the research is, what's the objective function? What are we trying to improve? What are we trying to maximize? Or as I laid it out here, what's the objective measure of resilience? We want to improve resilience in the system. Do we have a consensus on what's an objective measure of resilience? We really don't have it here. And when I look at some of the research and skin in the game, they tend to ignore these aspects. So what percent of what? Capital measured, we know the CCP capital that's in the numerator, what should be in the denominator. There are ideas being thrown about just having, skin in the game at one step of the waterfall is insufficient. You need to have a senior, mezzanine, and junior. And then where do you place it in the waterfall? And then there's this larger issue, and once again, these guys will get into it, is CCP and clearing member incentives, and all these conditional on regulations. So I'm still waiting to see a research paper which lays out these things in a systematic manner and assesses the skin in the game issue. I've seen a lot of papers, maybe half a dozen plus papers looking at skin in the game, but haven't seen any which sort of looks at these things in a systematic manner. So once again, the issue is, to answer to this question, need to know where am I today and sort of what are the trade-offs. And at this point, I'll hand it over to Richard and Robert.
So I'm going to jump off from that last point. I think very much the discussion that we're going to have in this panel is based on the idea of trade-offs. And as Saeed mentioned, often academic literature is, in some sense, one-sided. There is a focus on kind of an increase in safety and soundness is good, and you can achieve an increase in safety and soundness by doing the following thing. An increase in, say, market access is good. You can increase market access by doing something different. Of course, we know that in many cases, and I think we brought up in public forum a number of those cases, what is actually true is that these are balanced off, right? And an increase in one means a decrease in the other. And so we as regulators, you as market participants, policymakers, very much need to take that into consideration and really get a sense of how academic literature can inform that, realizing that a lot of academic literature may be only looking at one quarter of the issue. We have a list here on the slide of a number of these areas of trade-offs that we think are interesting. Risk management, of course, incentives there are, of course, a number of different types of actors. There's the clearinghouse, the clearing members, and the customers of clearing members. I think we have representatives of all three groups here in the room right now. And it is often very difficult to determine the appropriate balance between the incentives of those actors and what it will mean for the system as a whole, and that's in some sense where the regulator comes in. So what Rob and I, and he mentioned this right at the very beginning, we'll go kind of back and forth on a couple of these issues and then open it up for dialogue, because of course we're just we're opening up the trade-offs that we are certainly interested in, but need to continue to get feedback. Everybody is very much aware that clearing has increased over the last, say, decade, in part due to the clearing mandate and other regulatory changes. So I'm not going to stop on that slide. I'll move to here. The G20 mandate came out because there are clear benefits of central clearing. Listed here are a handful of them, right? Higher risk standardization, a higher transparency for the market, for regulators such as us. A potential increase, not always, academics have spoken to this, a potential increase in the amount of netting that you can do, because of course everything is centralized in one place rather than diversified across a number of counterparties. But and again, I'm feeling like a broken record. The movement into clearing is clearly not just a question of, okay, we get all these benefits as we push there. It is a question of a risk transformation. And with that general theme, and we have to be very, very cognizant of that risk transformation. And I'll pass that theme over to Robert.
Okay, thank you, Richard. So I want to make the conversation a bit more concrete at this point. At the risk of touting some work that I and my colleagues have done at the Federal Reserve Bank of Chicago, we talk about a concept that we internally call the conservation of risk principle. We're modeling this concept on laws of physics. We're not quite sure whether that's the right heuristic for what we see happening in risk trade-offs. But clearly there's a relationship between credit risk mitigation and the reliance on time-critical liquidity and the importance, by the way, of the supporting infrastructure, the operational integrity of the mechanisms we use to control credit risk. Let me take us on a very short historical tour. I promise you I won't go into all the nitty-gritty detail that I'd really love to share with you, but Petal wouldn't agree to allow me to speak for 4 hours about this. There was in 1974 a very important incident, the failure of Bankhaus Herstatt, widely noted in the policy literature and not so well understood in terms of its implications for the modern payments infrastructure. We focus an awful lot on Herstatt and what it told us about the need for international regulatory coordination, and of course that's an important part of the story. Less well known is that the CHIPS payment system, which was the critical mechanism for settling the US dollar leg of foreign currency transactions at the time, was operating on a deferred end-of-day net settlement system. And without getting into the thorny details, let's just note that when Herstatt was taken over by the German banking regulators at the end of the banking day in Frankfurt, it was still in the morning, early in the morning, New York time, and the participants in the CHIPS system took quite rational steps to protect themselves from the credit risk exposure implied by the failure of one of their participants. That led central banks globally to focus on the vulnerability of deferred end-of-day net settlement systems and to promote in its place real-time gross settlement systems, which since then have moved on to much more sophisticated hybrid systems. Following that in quick succession was the adoption for security settlement systems of the delivery versus payment arrangement. After long years of effort, the payment versus payment system that we now have in the CLS system and in Hong Kong and other places for the simultaneous exchange of foreign currency obligations to eliminate the kind of temporal risk that was evident in the Herstatt incident, as well as more broadly collateralization and ultimately the adoption of a mandate to centrally clear swaps. For me, this represents a consistent and rational decision by policymakers to implement mechanisms to mitigate credit risk. But risk, like energy perhaps, doesn't disappear, it isn't destroyed, it gets transformed. And what I would say is that that credit risk that we properly seek to manage through clearing and other mechanisms gets transformed into liquidity risk as well as operational risk. Is that a sensible and a reasonable trade-off? My co-author and I think so. In a world where there are mechanisms to provide with immediacy the liquidity needed by the markets to allow clearing operations to continue to operate in a safe and sound fashion, we think that the substitution of liquidity exposure for credit risk exposure is sensible. But it changes the system in ways that are quite unpredictable. It makes the system more interconnected. It creates what we call time-critical liquidity needs, the ability to satisfy obligations with a high degree of time sensitivity. And here, there are other implications. We now recognize in this new environment the importance of liquidity alongside our proper concerns for solvency. The two are distinct and need to be addressed distinctly, but in relation to each other by policymakers. Here I have a few remarks about the way that the legal structure and more importantly the market structure for central clearing operates. Will you move to the next slide just to show the image? Oh, do we have the hub and spoke? Okay. Doesn't matter. You will all have seen the illustration showing the opaque bilateral markets compared with the beautiful simplicity of centrally cleared markets. That illustration is true, but inadequate. There is hidden complexity in clearing arrangements. There's also hidden vulnerability, as we saw in bilateral, uncleared markets. Here again, we experience in concrete terms the kinds of trade-offs that Saeed was calling to our attention. I think I will stop there, Richard, and turn back to you for discussion of collateral demands.
Okay. I'm actually, given that we're on this liquidity discussion, and I think one of the liquidity is very much the critical risk or the critical component of CCP risk management. I want to kind of skip over to what we've called default preparation, or of course the funds that are there available for the liquidity demands of the CCP, especially during stress conditions. And we know that these funds come in a number of different types. We have mutualized resources, the default fund. We have the assessments, the potential assessments on members, which are in addition to the default fund. We have unmutualized resources, which is primarily the initial margins associated to individual member positions, and then of course we have skin in the game, which is what comes from the CCP. And the relative size of these three things, of these three kind of liquidity pools, dictate in some sense the relative incentives of all the members, as everybody knows. And it is in some sense, it is a difficult question to really understand what the appropriate distribution is across those three pools, and two, whether there is one right answer, which I doubt, or whether there are a number of right answers, and perhaps which one is most relevant to, say, swaps, which one is most relevant to futures. A couple of things that academics have discussed is a few forces which may not be entirely obvious, maybe they are entirely obvious, which can affect the levels of these things beyond, hey, I'm a clearing member and I don't want to shoulder the burdens of somebody else, so let's push it over here, or things similar to that. Of course, we are in a low interest rate environment, so the high quality collateral that's associated to initial margins is quite cheap now. Not surprisingly. So it is on a relative basis pretty easy to post things like cash, things like treasuries to the clearinghouse to satisfy the initial margin demands and the variation to margin demands. Of course, as a few academics have pointed out, that becomes much more difficult as rates rise, which is the environment we find ourselves, and also when there's heterogeneity across members and across customers. Not surprisingly, once the heterogeneity comes in, then there is a little bit of concern from let's say the high credit quality members mutualizing their default preparation with others. So these are of course things that we need to take consideration of, not only as regulators but as participants, especially as the world moves into kind of a new equilibrium. So I'll pass that back to you.
Thanks, Richard. So Saeed mentioned the difficulty of specifying what the objective function of clearing is. This is critical to the construction of a well thought out economic approach, to say nothing of an economic model for clearing, and yet we don't seem to have consensus about what the objective function is. I'd like to propose that it's pretty simple. CCPs are commitment mechanisms. They are part of the fabric that establishes trust and confidence in market structures so that parties that do not know each other may trade with each other anonymously and cannot know each other, but have value to add to the marketplace, liquidity to supply to the marketplace, can do so with a high degree of confidence that the obligations of both parties will be carried out as they struck them in the trade. This makes CCPs quite different from most other kinds of financial institutions and intermediaries. It means in particular that CCPs are not banks. If you are familiar with the work that I and my colleagues at the Chicago Fed have been doing, that's a theme that we've been trying to communicate to warn policymakers against the fallacy of thinking that we can take a policy structure that is designed for banks and simply impose it on things that are not banks. Because CCPs are commitment mechanisms, the objective function of clearing is to maintain in an orderly fashion and, when necessary, reestablish a matched book so that clearing members can maximize the benefits of those open positions that they entered into voluntarily, that were priced at market prices, for as long as those open positions have value to the community of clearing members. It's a very difficult balance to strike exactly what that value means. It depends on the coordination and cooperation among all the participants in the clearing universe, and that's precisely what the rules of the clearinghouse, the default management program, the default waterfall is intended to do. It's intended to create an incentive structure that supports the continuity of open positions at the clearinghouse. This is very difficult to accomplish. The rules of the clearinghouse can specify how the clearinghouse will go about its business and who will bear what obligations up to what point. But what cannot be specified in the rule book or in public regulation for that matter is the continuing value of the matched book to the community of participants that benefit from clearing. And that's the clearing members and their customers. I want to emphasize one thing at this point. Combined with the necessity of restoring a matched book under those situations where a clearing member may have defaulted is the need to absorb money losses. That's quite clear, but money, the allocation of money losses does not in and of itself return the clearinghouse to a matched book. We have to clearly distinguish that part of our regulatory and resilience framework that focuses on money from the part that focuses on the continuing value of the open positions carried by clearing members. Richard, do you want to go on and talk about the waterfall issues?
Sure, and kind of in preparation for this slide, and I think this is where I'll leave it myself. I also want to emphasize, kind of go back to some of the original things that we said. Of course, in 40 minutes or however long, we're clearly not going to solve any of these issues. We're merely here to lay them out. And we're also attempting to lay out some of the questions that we ask internally on both a kind of an economic within an economic framework, but also within kind of a policy framework, and to ask all interested parties, not just academics, but market participants, about how quantitatively we should really be thinking about these issues, and how within an analytic framework we should do some of these, calculate some of these trade-offs and find what we would hope to be at least close to one of the optimums, if not. Let's say a local optimum, even if not a global optimum. So with that, I will kind of go to the end of the waterfall as we move hopefully closer to a matched book, and some of the. I'm going to go quickly and get it back to side. Sure. One element of this is, of course, the fundamental question is, in some sense, the loss allocation rules. How are we going to allocate the losses that go beyond the standard methods in the default waterfall? So after we've made it through the default fund, and I've listed two here on the slide as I move over to it. The first one being one of the most popular variation margin gains haircutting. The one at least I see the most discussion about, and I in some sense I think one of the reasons we see a lot of discussion here is because it's very similar to what we see in banks. I think Robert has noted that CCPs are often considered banks, and the solutions for CCPs look a lot like the solutions for banks. And variation margin gains haircutting is an echo of haircuts to bondholders, right? Haircuts to those who have liabilities to the CCP. But unlike in that case, it's impossible ex ante to figure out who in fact is going to take those losses. So I think that can be very difficult, especially when we're talking about systemic institutions having to bear the losses associated with the haircutting. And the last question, and I will leave it here, is how are we to determine? Of course, there is a subset of people who are on the gain side of the variation margin payouts, and there is a subset of people who are on the losses side. So there is, of course, conflicting incentives of pricing the contracts as we do the haircutting. So I'll leave it at that and move on to the conclusion and questions.
So I'm closing. Okay. I want to sort of abstract away for a minute from the CCP issue. There is, and many of you would be aware of the fact that there is a very concerted effort underway to assess the impact of the reforms. There's strong interest in doing it, and looking forward to the next few years, I can see us sort of trying to pull together these issues from just in the context of CCPs. There is this market structure angle, so you want it to be sort of a matched book and going entity. And there's this debate that's happening between when you think of the reforms and the regulatory structure balancing the solvency needs of the system with sort of the liquidity needs of the system. So the macroprudential and microprudential thing. And when you look at CCPs, actually gets together. That's a debate which will continue to happen, but it's and also the fact that we have a lot of data that's coming in that my colleagues from the risk surveillance branch were talking about. We see as the rules have been implemented, we see a lot of voluntary clearing happening, and what are the sort of the factors sort of driving it. There is this there's one chart which we wanted to put out here, and we decided not to at the last minute. Was on the vertical axis will be the whole sort of regulatory structure for CCPs, recovery, resolution, and what have you. And on the horizontal axis is what's the probability of a CCP blow up. And then we had a big question mark in there because I don't know where I am today. Right, it's like the steps have been taken to make the system more resilient at sort of a very broad level, where are we today? So I think just answering that question is going to keep us busy. But this is one of the things wherein we can't figure these things out on our own. And as Richard was saying, open to this committee and the academic world to come reach out to us and talk to us about how to model these things and how to study these things.
So one of my former bosses at the Chicago Fed used to say that what you see depends on where you sit, and you sit today in the offices of the CFTC at this meeting of the Market Risk Advisory Committee, and so this is your opportunity to share with you your thoughts about the points we have raised. As both Richard and Saeed have pointed out, our effort today was not to try to solve these thorny problems involving irreducible trade-offs, but rather to think more clearly about them. We'd be delighted to have your input at this point. Please, in keeping with the tradition of the committee, just raise your name, tent, and we'll call upon you. Eileen.
Thank you very much. My name is Eileen Kiley, and I'm here representing BlackRock. I'm here on behalf of BlackRock's clients. We are an end user of the infrastructure. We do not actually belong to a CCP or have a direct relationship with the CCP. We access them through the third-party intermediaries. So with that caveat, Saeed, I was very pleased to hear you acknowledge that there's a lack of comprehensive research out there that addresses the issue of CCP capital. And that is something that BlackRock is actually looking to the regulatory community and the academic community to please provide, because I don't think many of us around here think more capital is necessarily better. There needs to be the analysis done that shows what the optimal level is that, doesn't introduce moral hazard on behalf of members, but, still incents the CCP management to practice solid risk management. And to that end, I think, one of the key things that I thought was missing from the discussion was the fact that CCPs are for-profit entities for the large part. And I think that is a critical element in how you need to think about this analysis, particularly when Robert, you say that there are commitment mechanisms. I would characterize it slightly differently. We think of CCPs as providing a service, and that service to our clients is credit risk mitigation. And that service has a price that we've paid for, and we hope that we get what we've paid for. So when you liken variation margin gains haircutting to haircutting bondholders, I would respectfully say the actual analogy is to haircutting depositors, because depositors pay for fees for their bank deposits. We're paying fees for the credit risk mitigation. And it's really, I think the bondholders analysis is a little bit too far. I'll leave it there.
Luke. So Chatham worked with end users, both financial and non-financial, and bumps up against the trade-off that you have elevated here between credit risk and liquidity risk, in so much as some of them are subject to the clearing mandate, and that places liquidity, time-critical liquidity demands on them, which for varying market participants are more or less tolerable. Are there ways, in your view, of retaining the resilience benefits that attend clearing to the system while lowering the liquidity burdens that are placed on market participants?
Well, so I think the answer is yes. I think having some respect for market selection of the means for mitigating credit risk can be beneficial, right? We had a relatively stable environment for a long period of time that allowed both the flexible credit risk management in the bilateral space and the more rigorous, rigid credit risk management with the attendant liquidity consequences in the clearing space. We decided for policy reasons to change that balance. I think it's incumbent upon us, if the liquidity demands that you are mentioning are important drivers, and I assume they are, it's incumbent upon us to continuously examine the policy balance that we've struck. There's no reason why the trade-off we decided in the immediate aftermath of the crisis has to be the right balance forever. Kim?
I was interested in your comments about the importance of continuity of the matched book, or of the clearing mechanism. And we have always looked at, I'm sorry, I'm Kim Taylor from CME Group. I represent a CCP view. We have always looked at what a CCP needs to provide as the continuity of the funding, the money, the client's money, the hedge or position that they have on, and their access to the market to manage that. We've always looked at the continuity of those three things as being the goals that we would strive to achieve in a default. And I think they line up with your idea of the continuity of the matched book. Where I see an interesting tension and actually somewhat worrisome tension emerging in the market these days is in the way that resolution regimes are being put forward. They're being put forward in ways that in many instances provide an opportunity to undermine the continuity of the clearing mechanism while actually purporting to support the a good resolution outcome. But the focus on pre-planning the end result and jumping the gun potentially on the end result in the interest of kind of governmental preparedness is perhaps undermining the ability to keep continuity of the book. And I just wondered what your thoughts are on that.
So working in an economic research department gives me a certain flexibility when combined with the disclaimer to say things that some of my colleagues on the panel may not be at liberty to say. Yeah, I share some of your concerns, Kim. I talk about a thing that it's akin to jump to default risk. It's jump to resolution risk. We surely don't want that. Frankly, under conditions we must accept as binding, such as the absence of public funding for solvency to restore a troubled market infrastructure, I think we are stuck with recovery. I don't know, frankly, what any of the current proposals about resolution add to what the clearinghouses have already embedded in their rules, together with the coordination and cooperation and natural incentives of the clearing members to preserve the value that's reflected in the book in order to draw a conclusion about whether to undertake the additional steps necessary to restore the matchbook or surrender the value embedded in those positions and tear up the whole venture completely. That seems to me a decision that is necessarily taken by the primary stakeholders in clearing, and policy should not interfere with the ability of the clearing community to make that decision as it seems best under all of the terrible circumstances we would be facing if such an event were to be necessary.
So, Robert, quick,
Yes.
so you're basically saying resolution authority and bankruptcy don't work as effective tools.
I can only think of a handful of ways that the bankruptcy model, the intervention by a resolution authority, improve what will necessarily be a terrible situation. It could be that the stakeholders in the clearing venture are not able to collaborate in an effective way. There may be some animus that develops out of the situation that leads up to the crisis or through the efforts of the clearing community to resolve the crisis. The intervention by the sovereign to come in and explain clearly and directly that there is a broader social value to clearing could be extremely beneficial. In the absence of public funding for solvency, I'm not quite sure what more there is to do by the resolution authority that hasn't been done or can't be done by the stakeholders, the primary stakeholders in clearing. Kim?
And Commissioner, just to add a little bit as an example of one of the ways in which it, I think, creates risk, some of the proposals, and none of this is finalized yet, but some of the proposals that are out in the market would suggest that the resolution authorities would not enforce various elements of the loss sharing models that are in place in the clearinghouse's rules. For example, some of the early jump to resolution risk elements include undermining the mechanisms and the incentives that already exist, or giving the marketplace an incentive actually to ask the resolution authority to come in so that the current loss sharing models will be avoided, and then and then you jump to resolution as opposed to establishing continuity. So they undermine some of the incentives if they go in the way that some of them have been brought forward.
Dale?
I'll echo Eileen's comment. We look forward to more research in this area, and to expand a bit on Kim's comments as far as jump to resolution. There's notice that there was some talk about skin in the game, and there should be more research on that. And again, I'm sorry, Dale Muggins from OCC, non-for-profit CCP. One of the other things I'd like to see is when we look at assessment powers, to make sure that those are robust as well. Because when we talk about the tools of variation margin haircutting, talk about partial tear-ups, initial margin haircutting, these are all tools that we never want to see in this market. I don't know if they're going to actually work. And no matter how much planning that we do ex ante, when the actual time comes, if we had to use these tools, these will be disastrous type of events. So I would look forward to making sure that we have the ability, as Kim mentioned, as far as ensuring that CCP is able to go through their default procedures, and ensuring that we also have some research done on making sure we have expansive and credible assessment powers. Thanks.
Certainly a rich agenda for additional work to be done. Marcus?
I want to take a different angle on resolution, and this is the intersection between bank resolution planning and clearinghouse sustainability and security. As most people would know, part of the process of bank resolution planning is that the bank under receivership is supposed to be able to maintain its membership and fulfill its responsibilities in market utilities, including clearinghouses, and that's connected to the resolution, liquidity, execution needs that are planned for the bank. So the liquidity that it has to reserve in preparation for a potential resolution, or in Title I, a conventional bankruptcy. And it does seem that from the Treasury report last week that there is pressure to sort of weaken the liquidity planning elements of the living will process. And I was wondering if you, first of all, what you thought about the connection between that kind of liquidity planning for bankruptcy or resolution of a major entity, the living will process, and what impact that might have if on clearinghouses if that liquidity planning process was weakened or made less stringent.
Economists have very little to say about this. It's interesting. I'm sure Robert is happy to sort of respond to your question. But my bedtime reading is this latest book by Rick Bookstauber. I can't remember the name. It's on Kindle, so I can't sort of see the cover every time I open it. But the Rick Bookstauber, who used to be at the Office of Financial Research, he used to be at Morgan Stanley, and now he's at Berkeley. Fascinating book. And the case he's making is that traditional conventional economic analysis, the approach to so modeling that we're talking about here is not of much help when you're talking about crisis situations. So that's, and economist by training, I have to agree with him. Most of these models and the analytical methods work during normal market conditions, but during a crisis situation, when you're talking about resolution, economists don't have much to say. And then it gets back into this issue between when you're looking at the solvency, right? And the tension that we return to is the market structure versus the institutional solvency. Do you want the thing going and running and sort of have the market running, or do we want to sort of figure out, because if you get into the resolution, the question is the CCP is stopped. My understanding is that when you're triggering resolution, that's the end of the CCP as a marketplace, because without the CCP, the marketplace is not there. You're maybe in the bilateral space, and even that is bound to shrink. So economic analysis doesn't have much to say yet about these issues, and which actually, as an economist, gives me a pause when people want to propose more rules in terms of how to have prescriptive requirements for managing resolution of a CCP. But that's me.
Petal, we are over time, but if you would allow just a few minutes just for one further question. Yeah. Barney?
Thank you, Robert. There's two separate topics I just want to make some comments on. It's not about resolution. The first one is, Richard, you made a comment about the most popular tools being variation margins, gains haircutting, and initial margin haircutting. I would say those are not popular tools. So if you've actually, hear me out. So if you read any of the industry comment letters to the CPMI OSCO consultation from last summer, it's very clear that they're not popular. In fact, There's been a lot of discussions with the European Commission and others in Europe to explicitly prohibit the use of haircutting of initial margin. On initial margin first, our view, and I should say I'm Marnie Rosenberg from JP Morgan, and the views I am expressing are our firm-wide views at JP Morgan. So we both are a clearing member as well as a dealer, and provide liquidity, settlement bank, and custodial services. So the first thing on is IM haircutting. Our view is that all initial margin should be bankruptcy remote. As a first matter, and there should be no assumption that participants' initial margin should be used to cover remaining losses. On variation gains margin haircutting, I think even among many of the CCPs, it's not viewed as sort of a popular tool. From our perspective, we view it as something that is akin to a payment default, and we should be provided a senior claim just like we would if a clearinghouse went into bankruptcy. In terms of academic research, I would first reiterate what Eileen Kiley said from BlackRock, that I think where more work could be done, and we made the recommendation as well as BlackRock in our recent paper, that there should be more quantitative impact studies done by regulators, policymakers, academic, to really look at and evaluate capital across the system from a CCP perspective, and what the impact on incentives could be. You guys talked about skin in the game and sort of at what tranche, but there's also the whole non-default loss framework, and I think that needs sort of further work and discussion because, Robert, as you mentioned, we're transforming from credit risk to operational risk, and that's something that I think could use a lot more work. So thank you for your comments.
Thank you very much. Petal.
Thank you very much, Robert, Richard, and Saeed for that. And thank you, Eileen, for being on hand for questions. We'll now take a 10-minute break and reconvene at noon for our last panel. 3 minutes will begin. Okay, please have your seats. We're about to begin. It is my pleasure to call this meeting back to order. As noted in today's agenda, our third panel will be on market input, Brexit's effects on markets. I would like to introduce Mr. Ed Pla of the Futures Industry Association, who will facilitate and help shape the discussions during this third panel.
Thank you, Petal. So for this panel, we've broken the discussion into 4 separate, broadly defined discussion topics. And I think what we're trying to achieve is sort of an evaluation of the pre-Brexit state of play, what the effects of Brexit could be, and what the effects of Brexit might be after 2019. So I think on the first point, where we look at maybe the reaction to the Brexit decision and the industry's preparations for eventual Brexit, I guess the opening statement is, aside from maybe the initial market surprises and some extreme market moves on the couple days after the announcements, the market seems to have taken the Brexit decision in stride. And I think the topic of the first set of questions is around understanding whether or not that's valid, or is there a latent reaction that we should be all trying to understand. So the first question, I guess, is, do you believe that markets have accurately accounted for the risks posed by Brexit as it unfolds, or do you think there could be shocks coming in the future? And maybe Eileen, if you could open up, that would be useful.
Yes, happy to. Thank you. belatedly thank you to the committee for inviting BlackRock to present the end investor perspective today. And before I make comments on the market, I just need to say that although many portfolio managers share these views, we have over 100 independent investment teams, so they're not necessarily reflective of everybody's views at the company. So we are in a market of significantly low volatility, both implied and realized, across asset classes and globally. And while one might be tempted to conclude that the markets might be underestimating risk, the implied volatilities have consistently been in line with the realized volatilities. This suggests that markets may actually be pricing risk appropriately. And we don't expect the details around Brexit to disrupt this low volatility trend. We do see evidence of efficient market pricing with regard to Brexit, particularly in the pound-US dollar exchange rate, which declined close to 30% since the Brexit vote, and then we noted a further 40-plus basis point decline on the heels of the latest parliamentary vote. And that's consistent with expectations for a more severe Brexit. And then this equilibrium was further supported by a lack of any observed crowded short position in the value of the pound. Nevertheless, notwithstanding the market's successful operation during recent and surprising geopolitical events and the persistent low levels of volatility, the market does continue to be susceptible to market shocks. We do not think that market participants should be particularly complacent in this environment. Absent a catalyst, low volatility could in fact persist for a long time, but the risk of an economic policy or geopolitical catalyst is not insignificant, and the impact of such an event will likely be large. We would expect to see volatilities to move well into the tails, and for those who don't operate in the land of statistics, what that means is that we would expect markets to react a lot more severely than our statistical models can easily predict. So while Brexit appears to be priced into the markets and the potential impacts of the hard Brexit seem to be largely constrained to the UK, there are numerous event risks that still linger in the market that could result in significant market disruption.
Across various markets, currencies, fixed income, equities.
Correct.
Yep. Biz, anything to add?
Yep. I'd broadly, echo Eileen's point. I think the initial Brexit vote set the stage that it introduced some kind of volatility that people kind of baked in regarding tail events. However, as we see it, the market is basically realized it's a long drawn-out process. There's various uncertainties that may play out over the next couple of years. We already saw a mini reaction with the election. So I think with regard to specific market instruments, we think the effective monetary policy will continue to drive a lot of the macro instruments, whether it's interest rates or FX. Whereas you probably see, as details become clearer with relocation strategies and the specific economic impacts, you probably see more specific impacts to sectors or certain, whether it's, financial sectors or corporate sectors. And that's all going to result out, we think, over the next, 2 or 3 years as people get more details. So I think what Brexit has placed right now is a stake in the ground that most stakeholders in the markets are factoring in some kind of future tail event volatility expectations.
Thanks for that. Luke?
Yeah, I would broadly agree with those comments. I think our clients as end users generally look to the derivatives markets as not sort of the source of fear as it relates to an event like Brexit, but really a source of comfort. In so much as, the various indices, currency exchange rates for those investing into Britain or those investing out from it, interest rates that change as a result of monetary policy in response to an event like Brexit. Derivatives are the tools that our clients rely on to mitigate against the uncertainties that come from those sorts of events. And so, I think on the one hand, it's reasonable to assert that the markets are efficient in factoring in information that is presently known. And I think the challenge with an event like Brexit is not a lot of information is presently known. And so I think it's what is certain is that there will probably be shocks to one degree or another in the future as this process unfolds, as the political process helps clarify market participants' views about the impact of Brexit on macroeconomic, on the economic situation with exchange rates and currency and interest rates. But again, derivatives become the buffer that allows clients to handle that uncertainty. And so I think that buffer served our clients well. For those who had hedged risks in anticipation of Brexit. And I think we expect it will continue to serve well to buffer against those risks.
Thank you. Dennis, it'd be useful to hear maybe an infrastructure provider's point of view on that.
Yeah, sure. At the time the UK referendum was held, there was a big market correction, and it stayed at that level, so to speak. There hasn't been that much volatility since, so it does seem like the Brexit risk has been priced in. I should say also that the currencies in question that are affected, the UK and the euros are only 30% of the swaps market. They're not 100% or 70%. So it's relatively tight. And the other thing to say is that 2/3 of euro swaps are done between counterparties who have nothing to do with the Eurozone. Either them or their parents are not in the Eurozone. So it's quite contained, and I think the derivatives market, in the swaps market, is certainly priced in the risk so far. But of course, who knows, but that's where I think it is.
So I think that gives us an overview of at least the state of the market and market reactions to the event, which leads to the next question, which is what are sort of the planning challenges that are taking place? I thought, Susan, maybe you could comment from a sell-side perspective what some of those challenges might be.
Sure. Susan O'Flynn from Morgan Stanley. For the purposes, my response is going to focus on cleared activity only. From a Morgan Stanley perspective, there are two key challenges for our European business, i.e. our UK broker-dealer, which currently faces off with the European clients. Number one, trading and access to European clients may no longer be available both from a house execution and client clearing perspective if we no longer benefit from passporting rights under MiFID. And number two, access to European CCPs may be subject to additional requirements, both from a CCP membership perspective for non-EU institutions, otherwise known as third country institutions, as well as domestic regulation in those jurisdictions where those CCPs are located, which impose additional requirements in order to be a member. Now, what is the planning we're doing as a result of this? As Luke said, we're dealing with a series of unknowns, but we think it prudent to prepare for a hard Brexit. Banks will have to establish a new European entity or relocate certain activity to existing European entities in order to continue to transact with European clients, both from a house execution and client clearing perspective. This entity may require new exchange and clearing memberships in order to ensure continuity of activity. Key dependency here is exchange and CCP onboarding capacity in a shortened time frame due to the large expected influx of dealers looking to be ready to trade well in advance of the March 2019 date. Significant resources will also be required internally to build out to our market structure partners in addition. Post-Brexit, what will we see? A new paradigm for derivatives trading in Europe and the UK. Dealers will have split trading and client coverage across two entities. From a house execution perspective, split risk and trading across entities will lead to increased costs for dealers, both from a margin and SLR capital perspective at the outset. This will be optimized over the longer term. Execution pricing may be adjusted to absorb those costs, which may impact all market participants. This planning becomes much more complex if equivalence of UK CCPs is not retained, or if a relocation of euro clearing were to occur, most notably for IRS. And I'm going to stop there.
Thank you. Eileen, I'm wondering if you could maybe share a perspective from the buy side that either echoes or maybe contrasts some of what Susan articulated.
Yep, I will echo that we are trying to manage through the uncertainty, and I think one of our biggest challenges is just keeping our structure nimble enough to adapt to whatever requirements as they solidify. But with respect to the clearing infrastructure in particular, given that we are an end user, we actually are looking to our clearing members to determine how they are going to need to structure, and we will adapt accordingly. I think what that means is, on the only thing we can know for certain is that there will be a large repapering exercise across our funds. But other than that, I think there's very limited clarity into what we might need to do.
Sorry, Dennis, how might CCPs be able to help, and what are some of your preparation challenges?
Well, I think the biggest, in light of the European Commission paper, which was released last week, which is the subject of the next question, but it's really laid it out what we have to do, because we would like to be in a situation, we welcome joint supervision from the Eurozone. We have it with the CFTC as well. So it's just another thing that we're well used to. And we just need to manage through the details of how that joint supervision would work. Namely, there will be specific liquidity requirements, things like that, which are slightly different, which we'll need to adapt to. But so I would see that our Brexit planning challenges are really trying to put in place the necessary, if you like, things we need to qualify to make sure that it doesn't trigger the relocation clause.
That's probably a great segue into our second topic. Dennis alluded to the recent ESMA proposal. So in ESMA's recent proposal, there's a provision that could deny third-party country recognition to CCPs of, quote, substantial systemic importance, unless they relocate to the EU 27. I know Cliff Lewis from York's Clearing, I believe, is dialed into the line. Cliff, I wonder if you could open up with some thoughts on what that type of fragmentation could mean for the markets.
Yeah, it's a good thing that we at Eurex are completely objective and don't have any interest in this particular change in policy, perhaps. Obviously, it's very early days to know how it plays out. And playing off a point that Susan made, it's incumbent, if these changes do take place, it's incumbent upon the various CCPs affected to work with their members and the end user community to make things as inexpensive as possible. So the question really comes down is costs versus benefits of a position which might affect the ability of a systemically important clearinghouse to operate for Euro outside the Eurozone. Now, the possible costs would, beyond operational and legal, which would be obviously considerable, is going to come in the form of initial margin. How much more initial margin would be required if this were to take place? The Eurex analysis is that the incremental margin, and this is different than what others have said, would probably not be a huge problem. And that reflects the fact that the European market, the Euro market, is a very large market and is a relatively balanced market with equivalent receive and pay fix end users. And in a way, I'm really focused on the end user community, which drives this. Obviously, the question of whether individual market participants might have to have additional amounts of initial margin, that obviously would be the case. But particularly if you introduce the ability to cross margin on a portfolio basis, listed and OTC rates products overall, I think our view is very defensible that incremental initial margin would not necessarily likely be material. Moreover, the numbers I've seen is in fact would be smaller than the current amount of excess margin at clearinghouses, which would suggest that it perhaps is not a big deal. This is after the transition. Obviously, transition issues could be serious. The question is whether the markets would be more illiquid. Well, that's, I think, really more a question of how MiFID II affects the markets. I don't think if there's not additional initial margin, if capital rules are not greatly affected, or indeed if, as the chairman is pushing for, the capital rules globally might become a little bit more sensible, then I don't think there's any inherent reason to see that the market in Euro would become less efficient after the transition period. Now, question of the benefit. The major benefit is that this proposed move would remove any questions as to the ability of the European Central Bank to provide liquidity in the extremely unlikely event that a systemically important clearinghouse found itself in a position where that was necessary. Now, to the extent that much of the risk architecture around clearinghouses assumes the ability of clearinghouses to access central bank liquidity, and I'm talking really very extreme circumstances, then risk managers could conceivably perceive there being a benefit from this change. And with that, I will keep quiet.
Thanks very much, Cliff. Dennis, as a risk manager, do you have any follow-up thoughts on that?
Sure. Yeah, I think the proposal or the potential to fragment liquidity is not good from a systemic risk point of view, because if you artificially fragment a smaller number of members into a smaller CCP and say, okay, you guys have to play together away from the larger global liquidity pool, then that means you have less members to absorb the default or a default situation. So you have less members to bid on a portfolio, to auction off the portfolio to, less members to which you could port a portfolio, less surviving members. And since you have less members overall, if you do the math and work out, even though you have less members and work out the size of the default fund structure, etc., you'll see that the assessments on surviving members in that smaller CCP would actually be orders of magnitude times what it is in the global CCP. So you end up by physically concluding that physically fragmenting a piece of a global liquidity pool off into one place leaves you with the systemic risk being higher than it is. That's the first comment. The second comment is that the cost would inevitably go up because you have portfolio margining today between many currencies, 17 currencies in my CCP. And if you break out one currency and try to treat that in a local way, then you lose the portfolio margining benefits between that currency and the other 16. And that can be quite substantial. We can argue about the order of magnitude, but it can be quite substantial. The other thing I would just say is that swaps are cash settled, they're not physically settled. So there is no role really for the central bank as the provider of liquidity of last resort for the cash market, swaps market, although there is for a physically settled market with a component such as repos where part of it is physically settled. That's a different story. And so many of us have CCPs in very different countries, and we have a CCP in Europe where we can deal with that problem. But for what we're talking about here, which is the DCO market, which is the interest rate swaps market, that's a cash settled market, and the need for a central bank liquidity is a little different. The other thing I would say is, just to echo my first comment, is that 2/3 of European swaps are cleared between members who have nothing to do with the Eurozone. Either they're not legal entities inside the Eurozone, or they're not subsidiaries, and they're not subsidiaries of parents who are in the Eurozone. They're just not anything to do with it. So what you would do by having this fragmentation is you would institutionalize an offshore market for euros, and I don't think that's in the interests of the European Central Bank to do that.
Thank you. Certainly your opening point about the potential negative consequences of market fragmentation, I think echoes a point that actually was on an FIA letter to the European Commission on June 6th. So points well made. Dale, I wonder if you could offer your perspective from OCC on those same questions.
Yeah, certainly. You know, it's I think a little worried about the unintended consequences of this possible solution, because we mentioned in the first questions, what do we perceive as the possible risk? I don't think we could know the possible risk of this political situation of trying to come up with rather than a market solution. The other thing, as far as we break up portfolios, and it's not even the explicit margin offsets that Dennis rightfully mentioned, but you start breaking up the diversification. And I've not done it for for this particular European swaps, but we have done it for portfolios within OCC or in prior jobs at other CCPs, where you start breaking things apart, and the margin does go up, and the clearing fund goes up dramatically, because what was looked at as stress tests and uncorrelated positions, when you bring those together, you don't need as large of a clearing fund as compared to when you look at everything singularly. The requirements that are needed actually substantially increase. And in the world where we're looking at the Basel requirements and coming up with all sorts of different ways to try to resolve some of the capital, capital limitations that we all have and are trying to face with from a regulatory standpoint, this seems to just add to the problem.
Great. Marnie, how about from a clearing member's perspective?
Sure, thanks. Marnie Rosenberg from JP Morgan. And I think Dennis and Dale have spoken a lot about the impact, but I'll just give our kind of overall perspective. First, we support a proportionate approach to oversight of non-EU CCPs in principle, but we're still evaluating the Commission's proposal, which just came out last week. But we do remain concerned about the potential negative impact of denying third country recognition to CCPs judged to be of substantial systemic significance. While the Commission's proposed regulation is not an explicit location policy per se, denying third country recognition would effectively force a CCP to relocate in order to continue to provide services to EU counterparties. This could cause market disruption, liquidity fragmentation, loss of netting efficiencies, which have been discussed. We do believe that the challenges associated with the growing systemic importance of CCPs and impact of Brexit can be effectively addressed through enhancements to oversight and recognition without requiring CCPs to relocate. I would say at this point, it's not clear to us as to which, if any, Tier 2 CCPs would be denied recognition and what the timing would be of this decision. It's clear from the Commission's proposal this is going to take quite a bit of time. And this in itself could impact market stability, leading market participants having to take early action based on an analysis of the worst case scenario. In terms of impact, as already mentioned and has been noted in many industry letters to the Commission, fragmentation through splitting of the portfolios would impact the market. One of the key benefits of central clearing has been risk exposure reduction, credit exposure reduction through multilateral netting and portfolio margining. Loss of netting and trade compression could lead to larger aggregate exposures to CCPs across the market and less efficient risk management. It could lead to additional margin requirements as portfolios are split, and reasonable margin reduction through valid correlation offsets that are no longer available. This means initial margin, default fund posted at multiple CCPs, potential assessment calls, as well as liquidity demands all go up, and not by choice of participants. Any denial of third country recognition forcing a CCP's activity relocation could also lead to significant challenges in default management during a crisis, which Dennis spoke about. Depending on the outcome, it is possible that we could be left with one EU-based CCP available to clear OTC mandatory clearable products and increasing concentration risk. There could be fewer market participants at the CCP, which would impact the ability of the CCP to liquidate trades and raise concerns over having effective recovery and resolution plans. Specifically, as there may not be a feasible backup CCP in the EU. Potential fragmentation could harm a CCP's ability to successfully port client positions, while the increase in the number of CCPs would lead to more CCPs requesting hedges and auction quotes from dealers and requiring trader secondment requirements, all of which, as we know, create a resource challenge in stress markets. This could exacerbate the already known collective action concerns of operational risks that we all talk about from a default management perspective. The other thing I would just point out is at the time of any transition, there could be obvious challenges in identifying the CCP that clears the same exact contracts, ensuring new memberships have been taken, redocumenting agreements, selecting appropriate segregation models, moving contracts in a coordinated fashion, funding IM default fund at both CCPs. All of this will entail significant challenges from an operational governance and legal perspective. And our view is sufficient time needs to be provided to plan, communicate, and implement these moves. Thank you, Ed.
Thank you. Chris, I think you also had some thoughts on this one.
We took a quick look at Chris Edmonds from Intercontinental Exchange. We took a quick look at the proposal that came out last week, and in one respect, we could say it could have been much worse. It could have been dictated when the policy came out that we all have to do the things that Marnie and Dennis articulated could be problematic if we have to do any of those. I think the bigger issue, and what sheds a little bit light on the recent parliamentary election and the risk proposed there of the changes in part of the leadership that's going on, is who's going to interpret that on both sides. And that we don't know yet. And there's still a great deal of uncertainty as to what individuals, because the words on the page are sufficient enough. We can sit there, but there are a number of what-if scenarios in there. And to Marty's point about who may be deemed a tier 2, who may be deemed systemically important or not, that is going to be a human interpretation that goes through that. And there's a lot to be learned left on what those metrics or how that interpretation may take place that causes us some concern as we move forward and have that, which is why we have to, like others, are making plans to support a market post those interpretations becoming more clear.
Thank you. Maybe just a quick round robin on some of the specific impacts that we could observe, including the propensity to engage in swap or enlisted derivative hedging and trading, access to clearing, cost of clearing, collateral efficiency. Eileen, I wonder if you could offer again a buy-side perspective on what that sort of potential fragmentation could result in terms of BlackRock's propensity to hedge or trade.
Absolutely, and I'll try to keep this brief. So I think very simply, our propensity to engage in swaps or listed derivatives is entirely a function of our clients' investment goals, as well as our portfolio managers' market views. So we don't expect fragmentation in and of itself to have an impact on our willingness and ability to trade. Nevertheless, fragmentation is expected to impact pricing and our clients' returns accordingly. But we will adapt and adjust as necessary to get the best outcomes for our clients, executing clear client trades where we can achieve the best outcomes with the due consideration for liquidity, cost, and governing law.
And Richard, your perspective on maybe both access to clearing and the potential cost of hedging and clearing?
Well, again, Richard Miller for the American Council of Life Insurance. For financial end users like ourselves, we're concerned, obviously, about the market fragmentation and the potential increased costs and all the uncertainty that now surrounds this. And it's interesting just to quickly reference an article in The Economist this past week discussing the ESMA proposal and observing that the complexity of the negotiations that are likely to occur conjures up images of House of Cards. And for me, that conjured up images of poor Zoe Barnes being thrown under the train. And I don't want to see end users like ourselves in that position. So we'll do what we can not to be.
Moving on from that image. Biz, I wonder if you could comment on potential collateral efficiencies or maybe inefficiencies that could result.
Sure, I think Dale kicked it off. Marnie's mentioned it. Eileen referred to it in her cost. I think we've seen people trying to speculate on what the cost and the breaking of the netting sets, and the only answer that everyone seems to be agreeing on is up. The cost of collateral, the need for collateral is going to go up. I saw an industry survey. I think it was from ISDA that said it could be anywhere from 5% to 20-30%. Obviously, not knowing the assumptions, who will it apply to, whether it applies only to EU members or EU clients will obviously impact. But for businesses like ours that either offer client clearing or offer liquidity, and we manage our risk of our the trades that exist, the absence of clear netting sets and how that so it's given, and I think everyone's assuming that the requirement for collateral goes up. I think that a couple of other questions come up And I think Chris alluded to is, we don't know what the decision is going to be, how many, new clearinghouses will be forced to set up in the UK, when that decision is going to be taken. But that creates questions around, the legal framework of collateral, how it will be treated, what would be considered eligible collateral. And for a market maker that is sitting between two clients, maybe on the same kind of a risk trade or interest rate swap, where one, product is going to be outside the EU and the other one in there, I'm in a back-to-back position, but the collateral requirement being different, both in terms of amount or in terms of probably quality of collateral, now creates collateral optimization, resources. So obviously, that's going to be a challenge. We've also seen recently with, central banks getting opened up to deposit, margin, and we've seen a good uptake and client interest in that. How will that impact the new CCPs if they're set up in the European regime? How open will their central banks be open to allow deposits? So I think away from the amount of collateral, there are other collateral issues that are kind of yet to be decided.
And on the topic of porting, Dennis raised the point about the complexities of porting. It's a topic that this committee has touched on in previous meetings. I think we still have Cliff on the line. Cliff, I'm wondering if you could maybe augment some of what Dennis said about the risks or complexities associated with porting in a potentially fragmented regime.
Well, I guess I think, if in the event that we get to an extreme case, post Brexit, I'm not so sure that the question of Euro market being fragmented. I think the Euro market will move lock, stock, and barrel. Now that may or may not be a good thing, but I'm not so sure that the fragmentation case applies. Now, the challenge of migrating the existing stock of open interest, just from a legal perspective, other than being a bonanza for high-priced legal talent, obviously doesn't add any value, and that fragmentation could be a very serious problem. The general point about making sure that the level of prudent risk management practices, particularly by end users in the EU 27, that it continues, is a problem. And as we've all seen, the amount of capacity to deal with regulatory changes overall is limited. And there are other hugely expensive and time-consuming market structure changes contemplated by the European Commission today, as well as any possible change in clearing. I think you'd have to become worried that you just overload the system in terms of what it can handle. I think from the standpoint of Eurex, administratively, we certainly believe that we can accommodate, in the event it was necessary, incremental customers, and believe we've set up a structure, both from a risk management standpoint and from an operating standpoint, that can accommodate that. But that's not to understate the challenge that this would impose on our clearing members and the end users, and the fact that it's in everybody's interest to make sure that, particularly given the macro scene that we may be seeing during this period, that people continue to manage their risks prudently. That's not a very good answer, I guess, Ed, hypothetical, but the best I can do.
Thanks, Cliff. Any other comments that people would like to raise or questions if you want to? Yes, Kim.
This is Kim Taylor from CME Group. I just wanted to add a little bit of thought here. I agree with the assessment of different kind of risks and impacts and disruptions that could occur from various ways that this policy could be potentially implemented. But I think I think it's important to remember that global policymakers do have market stability as one of their goals, and I have to hope, and I have to believe, actually, that they will take that responsibility seriously and understand that disrupting market access is not good for market stability, and uncertainty about the outcomes is not good for market stability, and that the policies that have existed in the past for collaborative systems of mutual recognition and outcomes-based approach to the regulation of and the mutual recognition of entities across jurisdictions has been good for market stability. I was actually very encouraged by the acting chairman's confidence that he expressed that this paper, this policy, will not disrupt the U.S. equivalence agreement. So I think we need to remember that that the policymakers will hopefully approach this in a way that supports market stability.
Any other questions or comments before we move on to the next? Dennis, please.
Yeah, just one comment. I think the document issued last week was placed the relocation in light of his essentially because of Dombrovskis' comments. It's a last resort. In other words, if the UK, the US, and the European regulators can sort this out between them as how this goes, what they have to do to make this work, then I don't think we face this relocation. So it's a question of exactly what the details are that we need to work through to make the status quo hold.
Okay. Next question relates to the potential for businesses to actually move in response to an eventual Brexit outcome. And if so, if there are businesses that are anticipating moving, what challenges they're facing, feasibility of addressing those challenges in the given timelines, which are tight. Biz or Susan, I wonder if you could maybe start by maybe describing some of the planning that you're making and some of the challenges that you're finding with those plans.
Sure. So Ed, I think Susan mentioned it when she spoke about it earlier. I think there's a number of different areas where people are exploring opportunities. Everyone realizes that moving either physical infrastructure, people, or other associated issues will take a multi-month, multi-year planning and execution exercise. I think so. From our front, the things that we are considering is the legal entities we have. We conduct various financial and markets activities out of bank and broker-dealer entities in Europe and UK. And so what is viable where, what kind of license and registration needs will be undertaken. The other issue we are thinking about is the effect on our clients. I think, Eileen, you mentioned repapering. And we've all gone through what the variation margin repapering exercise is taking. So we don't consider those issues very lightly. The other aspect, as we look at different jurisdictions and moving, is the issue regarding capital regimes that will start impacting. And obviously, the last thing we're focused on is risk. If we are forced to undertake a location-based entity and trading strategies, how we will centralize and manage our risk that's arising from executing in these various things. So these are kind of some of the things that I think planning is probably underway in very large magnitude, at least at our institution, and I would assume for most of our peers. But Susan.
I feel like I've got the same answer for this question too, but I think most banks and broker dealers are probably close to executing on a strategy, given the time frame we're working on. And if we think about predominantly derivatives trading and the amount of clearinghouses and exchanges we execute, that it's not just limited to Europe, it's also limited to the US, where we may effectively have to set up this new entity to be a member to be able to transact with our clients. So it is I would say a very large task, and I think given where we expect, or it seems the direction of travel is going around loss of passporting rights, this will in theory become a reality unless something materially changes with the tone of the Brexit negotiations.
Thanks, Susan. Chris, from a clearinghouse perspective, what challenges do you observe?
Well, I think most of those challenges are going to be are member related. I mean, we obviously have a facility in the Netherlands, and if it turns out to be that way, that we have to move certain products into that clearinghouse, we would move those products out of London to go to that direction. And then it'll be the conversation that Biz and Susan have articulated well, and the message that Eileen brought early. We'll have to adapt to that. It'll be a very rapid pace of adoption that we have to get through, and that will be additional stress on the market and on the end clients to understand what those rules are, what the capital is, and all of the other things that have already been articulated.
Any other questions or comments by doing this? Susan.
Just one thing, and it kind of ties into what Chris said, but also the previous discussion around, potential risk of euro clearing. I think the industry has started to get kind of numbers into the public domain around what the potential economic impacts are. And I think margin has been, numbers have been socialized through obviously ISDA. I think, as this proposal continues, I think it's incumbent on market participants to actually look at the other costs. And I think one that is kind of missed in this, in a lot of the, I suppose, submissions we've seen is actually the impact on SLR capital. Loss of compression, I think, is really kind of probably a bigger ticket item than margin. And I think, the industry groups together with the market participants have to get those numbers into the public domain to ensure that, the Commission is aware that it is not just a margin story, nor just an execution cost story. So that's just one thing I wanted to raise.
Thank you. And in the short time remaining, it seems fitting to end with maybe a set of forward-looking thoughts about what the state of markets could look like post-Brexit, post-implementation. Cliff, do you have any general thoughts on how you expect derivative markets to look, feel, behave subsequent to the outcome?
Well, I think that just 2 points on this. One is that I think that, thank God, the chairman is making progress on some of these bank capital rules. Some of the other major policy things, which I suspect in the end are probably at least as important as what we've been talking about today. The other general point is that, frankly, I think you see a potential serious divergence in pretty fundamental approach towards regulation in the U.S. versus the European Commission. And I think the consequences of that could be very, very serious. And it could be far more important, I think, than Brexit, for example, in terms of, I know people have speculated on this, it may be beneficial indeed to the U.S. derivatives industry overall. On the other hand, probably more likely is that it would have the effect of undermining some tools that will become much more important when we get back to an environment with real interest rates, which will happen at some point. And I think there's been a tremendous amount of kind of complacency with the kind of market environment we've had, where it's been very boring, except punctuated every once in a while by moments of pure terror, like the SNB move. And I think that under any scenario that we're talking about, it is likely that we'll have to face more periodic incidents like SNB, but in an environment where maybe the risk management infrastructure has been weakened. That's what I think we should be worried about.
Thank you. Eileen, any potential impact that you or BlackRock foresees in terms of market liquidity?
Yes, I think, despite my assertion that we will adapt and continue to trade for our clients, any forced relocation of market activity will negatively impact market liquidity. We certainly believe that. And we see that independently for 2 reasons. First, we would expect the capital requirements at our dealers will rise materially, both from the SLR perspective, but now they're going to have to independently capitalize across several jurisdictions. That will impact our cost and would reduce liquidity, and also due to some of what we've heard already, which is the splitting up of books across clearing members across CCPs, we expect that would have a trickle-down effect on their ability to take trades as well as unwind trades for us. And so we certainly see a negative impact from this move.
Dennis, a few moments ago, Kim mentioned the equivalence regime recognition. What potential impact do you see on registration recognition equivalence regimes as they currently exist today, depending on how things could turn out?
Yeah, well, I have one question after that proposal that was sent out last week. And why I welcome the proposal, it at least clarifies the situation a bit in terms of what needs to happen. There are all sorts of unanswered questions that have to be figured out now. For example, The CFTC regulates a DCO by service, not by CCP. Whereas, is this proposal really regulating CCPs and not the service? So if you have many services inside a CCP, one of which is systemically important to Europe, does that mean the whole CCP gets regulated by? So there's questions like that that have to be ironed out, I think. And it's really down in the weeds in those kind of details, I think, we need to get to.
I think we're nearly out of time. Any other final questions, comments, thoughts to share? Thank you all for your participation. Petal, back to you.
And thank you, Ed, for leading that panel. I will now turn to Commissioner Bowen for her closing remarks.
Great. Thank you to the Market Risk Advisory Committee members for another excellent meeting today and for your continued service. A special thank you to today's presenters and facilitators for bringing important substantive discussions to today's market. I want to thank Acting Chairman Giancarlo and the staff for their support of our work. This has been our 8th meeting of the MRAC in a little over 2 years, and I'm so proud of the work that this committee has accomplished. The MRAC has tackled significant market risk and market structure issues, including cybersecurity, market liquidity, portfolio compression, and interregulatory cooperation and central counterparty resolution. And of course, the committee spent a lot of time considering multiple aspects of CCP risk management, as typified by the outstanding set of recommendations at our November 2016 meeting. There's no doubt that the MRAC has left an indelible impression on our markets. Being the sponsor of the MRAC has been one of the many joys I've had as a commissioner. As the main cop on the beat for the complex and ubiquitous derivatives markets, the work of this agency is essential to supporting the safety and soundness of our economy. It is because of the high value that I place in the work that we do here that today I'm announcing my intention that I will leave the Commission within the next few months, or perhaps sooner, if another nominee is confirmed. Thus, unfortunately, this is my last MRAC meeting as the sponsor. So why am I doing this? The answer is quite simple. Since the departure of Chairman Massett, the work of this agency has been hampered by only having a 2-person commission when we should be a 5-person commission. In fact, we have not been a 5-person commission since the departure of Commissioner Amaya in August 2014. Having just 2 commissioners makes routine business difficult, but makes important policy decisions almost impossible. Without a full complement of commissioners to consider the far-reaching implications of our decisions, we're frozen in place while the markets we regulate are moving faster every day. This fact is intolerable to me. I came here to protect investors by supporting prudent collateralization, by promoting robust transparency, and ensuring vigorous enforcement in the derivatives markets. And I intend to continue to do all in my power to reach that goal. My hope is thus by leaving early, I can inspire key policy decision makers to confirm 4 nominees as soon as possible. There will be other opportunities to express my admiration of this wonderful agency, including its dedicated staff and its superb leader, Acting Chairman Giancarlo, so I will save that for a later date. However, I do want to acknowledge today my current and former staff members who have not only been dedicated public servants, but who have also been very supportive to me and a true pleasure to work with these last 2 years. Mark Pfeiffer, Eric Uzinas, Justin Slaughter, Jason Gizzarelli, and most recently, Corey Clausen and Steve Adamski. Petal Walker, who so ably took on the extra work as designated federal officer of MRAC, and my executive assistant, Vontrice Wilson, who superbly navigated the demanding task of keeping me and my staff organized and responsive to the various demands of my position. But I will say that this is definitely a bittersweet decision. As much as I relish my role as a commissioner, I believe that my leaving within the next few months is the best for this agency. I've truly enjoyed working with all of you, and thank you for your contributions and wish you the best. Thank you.
I'll now turn it to Mike Gill for some closing thoughts.
So my role is to provide some closing remarks on behalf of the acting chairman. And were he here, he would thank the members of the MRAC for your work and diligence in leading up to this meeting, and to the panelists for taking the time and sharing their presentations. In particular, I think he would want to note the first panel and the folks from the Division of Clearing and Risk who went through kind of the nuts and bolts of what this agency does in CCP oversight. And I think that's often an overlooked component to this debate. And so, Commissioner Bowen, thank you for providing the forum for the staff to share their expertise in that regard. Now, as you mentioned, there will be a time in the fall, hopefully a while longer, to recognize your contributions to this agency over your tenure. But as this is the last MRAC that you will be leading, we thought it appropriate to recognize your leadership of this committee. You have now set a new standard for our advisory committees. I think the timeliness of today's debate and the discussion are reflective of how this MRAC has really set the tone for quality discussions at the agency and kept us engaged in a lot of important topics. So it is a tradition to present a departing chairman with an honorary gavel, but we thought as clearly the chairman emeritus of the MRAC, on behalf of the acting chairman and the entire staff of the CFTC, we wanted to recognize your leadership of the MRAC with this token of our affection.
This is absolutely gorgeous.
And at the risk of breaking the fourth wall, I would want to once again invite people to honor Commissioner Bowen.
Thank you so much. Thank you on behalf of Chris, okay?
So at this point, as the designated federal officer of this committee, I am for the last time adjourning this meeting. Thank you all for attending.